Hello. I managed to do a bit of research today on economics in the EU because, well, as it happened, my computer was having trouble at work, so I had some time on my hands. And I found some interesting stuff on the internet, and it reminded me of some things, and I thought, you know, people are making a lot of economic arguments about we're stronger in the EU, we're better together and all that. I managed to find some info that maybe will counter that. I'll say I'm in favour of Brexit. I wasn't at the beginning, I was kind of neutral, but after looking at all the arguments, I'm going to vote out on Thursday. Unless something drastic happens and changes my mind. I noticed that David Cameron today is saying we're better in, we can negotiate with big countries like China and India, but as far as I'm aware, he hasn't mentioned that the EU has given up negotiating a trade deal with India, in fact, because they couldn't get 28 countries to agree, right, on all the various rules and things. So I don't think he's mentioned that, but anyway, let's try. The economic arguments are important because it's crucial to people's decisions. Some people are mad about immigration, some people are mad about, what's my job going to do? Some people are thinking about democracy. That's kind of my angle. I'm more into democracy and stuff like that. I want Western liberal values to survive. And this sort of fake Soviet democracy that they have in the EU doesn't cut it for me. And I think if we stay in and it goes ahead and it doesn't collapse, then in a generation or so we'll be really under the bureaucratic thumb and very inefficient economically, at best. So, let's think about some things that have happened with the EU economy and work out whether we are better tying ourselves into that or not. Do you remember, some time ago, the Cyprus banking bailout? After the big crash of 2008, which is the thing that, if you like, lifted the lid off all of the problems in the world's banking system, and particularly the EU and America, do you remember how all bank accounts containing more than 100,000 euros received what they call a haircut? Because the banks were failing, all the, admittedly wealthy savers, people who've saved a lot of money, or crooks, as they suspected, or that's what they said to make it sound acceptable to the public, right? Criminals banking money, but anyone with over 100,000 was thereby deemed a criminal. Had their money taken, or at least the surplus, to help bail out the bank. Now, I think in the UK we have a similar limit of £80,000. It used to be. It has been reduced to 75,000, and they'll probably reduce it again in time. But if you have no more than £75,000 in a single bank company, the ownership company, then your money will not be taken. As things stand at the moment, they can change their minds in a big crisis, of course. And I wanted to look at that, how it happened, why it happened in particular. I've got to look at my notes because it's complicated, right? But I'm not going to go into all the big details. I'm just going to talk about it in general because we want to make an argument for what's wrong, I suppose, since I'm in favour of Brexit. And I'll tell you, I haven't really found a proper economic argument against Brexit, in truth. There are some risks, certainly, but sorry if I'm crinkling the paper too much. There are some risks, but we don't know what they are or whether they're good or not. We just have to take our chances on that, I suppose. But why did Cyprus need to be bailed out? And why are the southern European economies so weak? We know that Greece, Italy, Spain, Portugal, and some of the Eastern European countries are actually in quite a bad way. And we must remember what happened to ordinary savers in Cyprus. Okay, it's caused by the euro, by the single currency, basically. In the natural world, any country, in fact it used to be in the old days, any one person could make up their own currency and compete with all the others. And that really is probably the most economically effective system. But we have countries, and if a country is getting into trouble, or their industry, if you like, their business is not competitive, their currency goes down in value, naturally. People don't want to invest in a country which is crap, right, for business. So the currency goes down, but that makes their goods more competitive, and it reaches an equilibrium point where they can compete in the markets again, and everybody's doing fine. And similarly, if a particular region is doing very well, a particular country is doing very well, their currency rises and rises and rises until they start to become less competitive. Now, you might not think that's such a great thing, but it prevents an economy from, as they say, overheating. It kind of stops things getting out of proportion in the world as a whole. It helps keep things in balance. The world economy balances itself out. Some currencies go up, some goes down, and overall things are kept at a sort of an efficient level. Within the United Kingdom we have something similar. London is like booming like crazy in the south, and yet in the north we have permanent stagnation. It's not because the people of the north are lazy or anything, it's economics. And because we have only one currency in Britain, really the north should devalue and make itself competitive, and it would recover really quickly. Instead, what we have to do is transfer wealth up to the north with benefits and grants for business and building extra infrastructure and things of this sort. And the EU is kind of trying to do this same sort of thing with the southern countries, but of course it's enormously expensive and it wouldn't work very well. It doesn't work very well. They're all different countries with different cultures. In Britain we're all more or less the same culture, right? It all works very well, but between countries transferring wealth doesn't work very well. You can imagine wealthy Brits, Germans and French really not being very keen on bailing out what they see as lazy, good-for-nothing, greedy Greeks and Italians and Spanish and what have you, right? How long are they going to want to do that for, with the huge amounts of money that will be needed? It's a big problem, or what we should have is more than one currency in Europe as the natural and historically effective way of dealing with these problems. But it's not allowed. That's one problem with the EU. And of course, what it all boils down to really is a debt crisis throughout Europe. And Britain has its own debt crisis. We have about £1 trillion of unfunded pension liabilities. You can find some videos online somewhere. Britain's £1 trillion horror story, I think it's called. It's worth seeing. They never mention that in our economic GDP figures. The pension liabilities are not included. Wonder why. So when we look at the countries that are particularly in debt, Greece, Italy, Ireland, Spain, Portugal and others, it's kind of been caused by the zero interest rates and low interest rates after the crash of 2008, and also even before then caused because with a single currency all the countries can borrow at like German and French interest rates, because those two countries are the powerhouse of the EU, obviously, especially Germany, France and Britain, but particularly Germany. So with a weaker currency they should have a higher interest rate to try and attract more investment and make them more competitive and so on. That's the way it works. But because we have a single currency and it's mostly determined by Germany, or has been historically, the interest rates are too low. So those countries can borrow cheaply. So they do. So they build up massive, massive debts, which their economies are not healthy enough to repay when payment time comes. And the banks all loan to them because they cynically thought, well, Germany's going to back it up, right? Of course. But they loaned them enormous amounts, and tons of bad projects were gone into. Like in Spain, there are something like 2.5 million empty homes that have been built along the south of Spain. All these speculative investment projects, vast schemes, uninhabited. Right. In Ireland, Republic of Ireland, lots of useless trading estates. I've written some note here that I can't even read. Well, they borrowed because it was cheap, basically, and then when the debt hit the fan, as it were, they couldn't pay it back. So these assets which they've built are not worth a lot because nobody wants to buy them. There's no business to be done there. The countries have not built up their business infrastructure. They built rubbish, right? Because it was cheap and it was just investors making money and whoosh whoosh whoosh. I'm all right, Jack. Goodbye. But now the debt needs to be paid back, right? Bit by bit. And these countries need bailouts because their banks are failing because they can't afford it. Their customers have all gone bankrupt and are not paying it back, or have closed their companies and have run off or whatever, right? So what do you get? You get bank failures, but the EU bails them out because they don't really want the banks to fail, because the whole system will go down like a stack of dominoes. The banks are all linked to each other. They've all got investments in each other and debts to each other and so on. So if one bank fails, it doesn't pay off its debts. The next bank fails, bang, 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 all the way through the system. It's terrible, right? Or they can try and encourage some inflation, which hides the debt. What inflation does, as the value of money goes down, your debt kind of shrinks with it. If you have a debt of £1 million, okay, and inflation makes £1 million worth only £500,000, you still have to pay back £1 million, but it costs you really only £500,000 in productivity, right? If you in the end you could buy a box of matches for £1 million, you could just pay off your debt, right? The debt doesn't inflate unless the interest rate is higher than the inflation rate. So you can be okay, potentially. And so governments like to inflate their debts because they have bonds at fixed interest rates. Their debts are usually at fixed interest rates. So they try to get the inflation up above that, and it knocks off the debts over time. Or they can keep kicking the can down the road indefinitely with a bailout every few months, like they're doing with Greece at the moment. Every few months there's another bailout, right? Which is us, we, the taxpayer, paying for it indefinitely. Okay. I'll talk about how much in a bit. Or they can do what they did in Cyprus and steal people's savings to pay for some of the bailouts. And if you think it's not likely to happen here, if we're in the EU, we adopt the EU's regulations, okay? And guess what? January the 1st, 2016, this year, the EU adopted a regulation which we have implemented too, because we have to, that the banks can steal our depositors' money too. It's called a bail-in. It's known as a bail-in as opposed to a bail-out. If you're invested in a bank, if you've got big savings in a bank, you are considered liable for some of that bank's risk. The thinking is you shouldn't invest in a bank that is badly run. Did you know that? Do you know whether your bank is well run or not? Is there any bank which is well run? Do you know? Darned if I know. There might be some. But at the moment, the limit in Britain is if you have £75,000 or more within a group of companies, a group of banks. So if you're with, supposing one banking group includes NatWest and I don't know who, RBS, say. I think they're in the same group. You have a total of 75,000 between them in your savings, then in theory you won't be subject to a haircut. However, that hasn't been tested with the new regulation. So it might, the British sort of protection system of 75,000 reduced from 80, remember, might not apply when it comes to the crunch. So just bear that in mind. And guess what? The Greek problem isn't the worst. The worst problem is in Germany, of all places. Pardon me. Deutsche Bank is exposed. It's 33 times leveraged on it has 33 times more debt than it can handle. Basically, they're allowed a certain amount of leverage. They can lend out, say, 10 times more than they've got in deposits, that sort of thing. They are at the legal maximum 33 times. They are exposed to 75 trillion euros, I think, or maybe dollars, about the same, euros, of debts. And I'll put up a chart of their share price recently. If you look at the end, you will see plummeting, right? How far are we from a banking crisis, do you think? Obviously nobody knows, but does that look good to you? They're also exposed to China very heavily, so if China goes through an economic crisis, that will crush them as well. That 75 trillion, by the way, is 20 times Germany's GDP, gross domestic product. The GDP of a country is its total output, economic output, basically. So Deutsche Bank owes more than 20 times what Germany as a whole can produce in a year. And the entire economy of Germany is hooked into Deutsche Bank, of course. It's a major bank in Germany. And the entire EU is hooked into Germany. And so not only is Germany pretending there's no crisis, okay, but Greece, Spain, Portugal, Italy, etc. are also in crisis. And little countries, when they join the EU, Albania, Serbia joining, Czech Republic, Hungary, Austria, not so little in some of those, they also get drained of talent and drained of small businesses who can't keep to EU rules. I mentioned that in my previous video about my general why I'm voting Brexit video. And it's all looking terrible, frankly. And just one more thing about the haircut. This new rule that came in January 2016, which was applied anyway in Cyprus long before. Austria, just in April, gave its large depositors a 54% haircut on their accounts for a particular bank when it failed, using the new rules. So don't think it can't happen in a major country, because it can, and it will. Okay. We can't say when and where, but do be careful. Don't keep too many cash or financial assets, money assets, in a bank, in one banking group. You could be in trouble. Split it up, invest in shares, invest in gold or coins or whatever, right? But spread it about a bit. The trouble with investing in coins is, of course, they're hard to sell for what you paid for them, but they're useful if the entire economy collapses. At least you can eat, because you'll have some proper money. So, I mentioned the low interest rates, and I need to say a bit more about it. The low interest rates have contributed towards this debt crisis, of course. Governments like low interest rates as well, because it allows them to get into debt themselves. They can run a deficit. They can do deficit financing much more cheaply. And they can make promises to voters and keep getting elected by voters who are mortgaging away their futures without realising it, by voting for handouts which are going to be paid for by their children. Or whenever the debt hits the fan properly, right? The zero interest rates delay or prevent, but usually just delay, the final crash, which happens when the banks start to fail anyway. And why are interest rates so low? They should have gone up after the economies should have recovered after the 2008 crash. Britain has more or less recovered a bit, but our interest rates are still low because our economy is still very fragile. And they're more fragile in Europe, and hence interest rates are low and even negative in some places. A negative interest rate means you have to pay to keep your money in a bank. Right. You have to pay even on a deposit account, right? A savings account. So their economies haven't recovered. And it's kind of because of these policies of not liquidating the debt, not allowing the bankrupt companies to go bankrupt, not allowing the bankrupt banks to go bankrupt. It sounds wrong. Surely you should be propping up the banks, not letting them fail. But actually, capitalism works because badly run companies, zombie companies as they are in this case, because they have no money, they can't survive if the interest rates go up, they can't pay off their debts. Zombie companies should fold because they can't do anything other than keep ticking over. They should fold and their employees should join new companies. The banks should be lending to new entrepreneurs. But they're not doing so because new entrepreneurs are risky. Instead, they'll loan money to the government, which is seen as safe. The government buys bonds from the banks, and so it goes. Right. The governments of Europe are buying 80 billion euros of bonds from the banks per month to prop themselves up. I think this is mostly just in Germany, frankly. It's the Bundesbank and others, but that means that the debt is increasing by 80 billion euros a month. Okay, now this is a debt crisis, and they're managing it by printing 80 billion, which they're loaning or buying bonds from the banks with. The banks have to pay back this 80 billion in the future, so they'll take out more loans, etc., etc. The banks are supposed to be spending this 80 billion that they're given on investing in new businesses, but they're just keeping it because it's risk-free. Right, they've got their balance sheets to sort out. There isn't really an incentive for them to invest in risky businesses. They'll buy more government bonds and stuff with it and hang on to it, and that's what they do. Of course, it may be that some of these governments will actually fail as well, and the euro might even fail eventually, and then big trouble, right? Big trouble, because this 80 billion a month, what's it going to do? Who's going to pay for it? Who do you think? Think about it. The public, right? We always end up paying. The low interest rates, of course, are bad for savers. And when interest rates are very low, instead of not saving, people actually tend to save more because the older people, for example, they rely on income from their savings. They have investments from their pensions and what have you, and they should be getting interest on that, and they live on it. So when interest rates are cranked down low, in order to encourage people to spend money, in fact, savers tend to save even more to try and get their income back up, their interest rate income back up. So it cuts down expenditure, it puts a lid on the economy. Look at how the EU has been flatlining since 2008 because of these policies. They're doing quite the wrong thing, and they are not changing their mind about it, they're just keeping on with it. Japan has been doing this for 25 years and they've been in a depression for all that time. They will not bite the bullet and let the bad businesses fail. Painful as it is, it will not be more painful than if you let it hang on for years and years and then fail 10 times the size. I'm afraid it's just hard luck. When things are tough, you just have to accept it. Accept the failure. But the politicians, of course, they don't want it to fail on their watch. They want it to fail when the next lot come in. So they kick the can down the road. They print some money. They lend out some money at low interest rates. And the banks, they will do something. They instead of investing in new businesses, actually it's not so much the banks, it's the big businesses themselves, because they can't really grow their businesses and show growth for their shareholders. They kind of cheat, and they show growth by taking over other companies. They take over like other zombie companies. They can get loans from the banks for that, to buy a going concern. Right. It's easy enough to cook the books to make it look like a decent company, and anyway the banks have to lend some money, so they try and lend it where they think it's going to look good. So the money is going into takeovers and mergers. These companies should really be investing in research and development, in new capital goods, in improved productivity, but instead they just take over another company and say, oh, it makes us look bigger. And it's a tax dodge as well. It's unproductive. It doesn't improve the productivity of the economy. It's just a waste. And new businesses which could be growing, doing new things, are starved of money and starved of investment. And look at the EU. No growth for 8 years. These policies actually prevent recovery. And even where there are entrepreneurs, there are these zombie companies in the way, plodding along but sucking up half the market. It makes it very difficult for new business. So what does the EU do when they don't want to change their zero interest rate policy? They have to keep bailing out the banks. They need to somehow improve productivity. How do you improve productivity if you can't get banks to invest in businesses, if businesses can't grow because there's zombie companies in the way, or they can't get the money? How do you do it? Immigration. If the population of a country goes up, its GDP, its economic output, goes up as well, because some of those people who come in are productive. They add to the GDP of the economy. But guess what? The GDP per capita, per person, tends to go down. There are more people there, and although the economy as a whole is bigger, it's shared between more people. And some of those people who come in are not productive. So on average, the GDP per person goes down a bit. That means your taxes go up a bit because you're having to pay for schools, hospitals and other infrastructure. Okay, now this isn't a racist argument, this is an economic argument, okay? Just to make it clear. This happens no matter who's imported into a country. It's fine when the numbers are small, the country can support it easily, over 20 years these people become productive, net. But But these increased taxes also make it difficult for the natives to breed, to have children. I mean, look at the situation in London now. We've got super expensive housing, fairly high cost of living, let's face it, and taxes are likely to tend upwards because the cost of the immigrants in Britain at the moment is something like 15 to 17 billion pounds a year extra. Despite the extra productivity from those who are contributing, overall it's costing us more in the short term, that is 10 to 20 years. Right. But politicians do it because it brings in more voters and it makes the headline GDP figure look better. And they're doing it all over Europe. And this immigration refugee thing is not a humanitarian cause. It's an economic one, a political one. It's incredible cynicism. So do you want to be tied to a Europe which is undergoing the most incredible crisis, disguised? They're keeping it out of the headlines most of the time, but you should read the financial press. Occasionally, at least. Financial Times is a good one. Best one. Hard to read, but the best one. Do you want to be tied into an EU that's like that? Just think, are we stronger tied into Deutsche Bank's, what was it, 75 trillion debt? Really? Trillion? Right? Not billion, trillion, right? Great Britain's GDP is 2,000 billion. A trillion is 1,000 billion, a million in modern parlance, right? And Deutsche Bank is in debt to 75 trillion, right? And that's just one bank. There's debts all over Europe, right? And Britain itself has about £1 trillion liability from the government for unfunded pensions. But do you really want to be tied in with all the rest? What do you think? Am I wrong? We only have a few days to make up our minds. I think we're stronger out, because I don't want to be forced to bail out Greece, Italy, Spain, Portugal, who knows who else, Deutsche Bank even. Sorry, we may have to contribute a bit even when they do fail, and they will. We probably will have to contribute even if we're out, but it will not be under EU rules and terms which have been proven to be a failure to prevent their economy from recovering. I think it's a disaster. If we stay in, we'll have to just put up with it, right? But let's hope we leave. Leave your comments below and like my channel, even if you disagree with me. Hey, what about it? At least I'm putting an argument together, unlike the Remain campaign. Okay then, bye for now.